Today we're going to be looking at the supply and demand strategy that is actually much more advanced than the standard supply and demand strategy you know of. About a year ago or so, I posted a video about DAX saying that his strategy is based on supply and demand, and I got some very funny comments about people saying that the strategy is not well understood and all that stuff. But in this video, I'm going to break it down for you through the very eyes of supply and demand, so you know that what this is Quasimodo reversal, Quasimodo continuations, and they are majorly just a very strong advance of supply and demand. So it's basically supply and demand advanced. If you do enjoy this kind of videos, do well to hit the subscribe button and like and share with people who you think may find this trading knowledge valuable to them. Let's head right into it. So we're going to be looking through all these situations today, everything here from start to finish. First, we're going to be learning each and every one of these to then understand the concepts. So what is a break of structure? In case you're new, you should not be worried. You're going to learn everything from scratch and you will understand this entire strategy in just this video alone. So what is a break of structure? A break of structure is when price breaks above or below an obvious high or low. In this case, let's take a good look at this chart here. We have the New Zealand against the US dollar. And first thing I want you to do for your practical, just for you as a person to practice this whole thing, is you can pause the video and tell me where you think is a high and where you think is a low on this chart. And I'm going to guess this is right here, a clear high, right? And then this right here is a clear low. So in between this high and this low, let's put a very good arrow through it. We're going to put an arrow through it. And in between this high and this low, I want you to take a look at if there are highs and lows in between it. So obviously there are a lot of highs and low in between this entire move, right? We have this one right here, right? This is a good high, and then this is a good low. So we've been able to see high and low. Now, what makes a break of structure? A break of structure is when either a high or a low gets closed above or below. So if it's a high, when price closes above that high, it becomes a break of structure to the upside. And when price closes below a low, it's a break of structure to the downside. It's a very simple understanding. That is what break of structure is. So in this case, this one, there was no break of structure here. Well, down here, we do have a break of structure to the downside. So we're just going to label it the BOS, right? Break of structure to the downside. Now, change of character. Change of character is basically a type of break of structure, but it's when you have a break of structure to the opposing direction of the last break of structure trend. So assuming you're monitoring all the break of structures that are happening on this chart, you're going to end up having something like this. Now, take a good look at this entire situation. We then have this break of structure, which is opposite to all the situation we see here. So you can see that all the situations we've been seeing are break of structures to the downside. They were all break of structures to the downside. And then we now found one that immediately opposed the entire situation. So this one that is opposing the current break of structure trend. You can see the break of structure. It was no longer a break of structure to the downside. It was a break of structure to the upside. This one is what we call the CHOCH, the change of character. Why do we call it change of character? Well, something has been going down, down, down. The character is that it is going down. And then it tried to change that character by going up. So that is why we call it a change of character. So it's a break of structure opposing the trend of break of structures we are seeing. So it is a change of character to the upside. Now, after a change of character, we start expecting to see break of structures above instead. So we start expecting to see break of structure upwards. We'll no longer be seeing break of structure on the downside, which is what you can see right here. You can see that this low price is not breaking below. The next break of structure is actually above that. So you can see that after a CHOCH, you start to see, or rather after a change of character, you start to see break of structures to the upside. So that is you understanding what change of character and break of structure is. So after this, you're supposed to now learn what market structure really is. So market structure is all of this situation, right? Market structure is, you see this line we drew down here, this line we drew down here. This tells us that the market is trending downwards. So how do we draw the market structure? We start relating lows to high. So this is the high, we relate it to the low, we relate it to the nearest high, and we'll continue like this. So this right here is the market structure of this particular move. It was making lower lows and lower high. And where do those words come from? Lower low, lower high. Well, this is the highest point. The high that was made was lower than this high. So this is a lower high. You see, this is another lower high. It transits to lower highs, transcends to lower highs. And then this low, this is the low that leads to this lower low. This leads to this lower low. This leads to this lower low, to this lower low, and this lower low, and this point. So now you understand market structure. This is how you draw market structure without having to overstress yourself or overthink it. You've understood market structure immediately. Even when price changes to the right direction, so in this case, for example, we had this break of structure to the upside, we have all of this price move. So we have the continuation is this, right? So with this your understanding now, it means that when price finally closes below this, we have a change of character to the downside, right? So we start expecting to start seeing lower break of structures to the downside, something just like this. We start expecting to see that. As you can see, this is a break of structure. We expect to see another break of structure to the downside, just like that. That is expectation. It doesn't mean it's going to happen. Remember, the word is expect. Now, we've understood market structure. The next thing you want to look out for is something called order blocks. So, what are order blocks? I have taught you this whole situation without mentioning the word supply and demand, which of course I told you I was going to teach you supply and demand. Why have I not mentioned supply and demand? This is the point where you see where we will finally understand how this leads to supply and demand later. But order blocks, what are order blocks? So when you see price movements, right? Before price makes a rapid move to one direction, it always leaves behind a small block behind it, a small candle behind it. That candle is called an order block, not the same candle. So let me just show you what I mean. So take a look at this situation. This candle was moving up. Green candles means up, red candles mean down in this situation. Let's just call it up and downs, right? So take a look at this one right here. This candle was going up, and then we had a rapid move to the downside. So you see this candle that was going up, this candle is what we call the order block. So this candle becomes your order block. And how does this relate to supply and demand? Well, it is simple. If green candle means up, it means there was buying. People are buying something, right? And if red candle means down, it means people were selling. Let's use the analogy of a Range Rover. Let's assume you have a Range Rover, and we all know the price of a Range Rover is around $300,000. So 300K dollars is the price of a Range Rover. Knowing that the Range Rover is 300K, it's going to be down right here at this center point, right here. I'm going to remove these lines because you already understand market structure now. You already understand the whole thing. Now let's take a look at this price movement that happened only in this area, just this area, nothing else. I'm going to hide out the others so you understand what I'm saying. So taking a look at the price movement that happened here, this price level is 300K. Imagine your Range Rover, you bought a Range Rover for 300K, let's say a day ago or 2 days ago or a month ago. And then you heard that people are looking to buy Range Rover, and the current price of Range Rover is, let's say, 600K right now, which is at this price level. You will definitely have this side of you that feels like, oh, I can sell this car. I can sell this car and, pocket an extra 300K as profit. So why is this a supply zone? Because this place is expensive. And this is where sellers would love to sell. This is where people who sell something, or an item, market, whatever, this is where they would love to start to actually sell. This is where they will want to place, this is where they want to sell the item. That's what you just call it. So this is a sell area. So if they started selling so many they started selling so many Range Rover at this price, because the fact that Range Rover is plenty and so many people are selling, Not everybody will want to buy it at 600k. So some people will say, oh no, I'll not buy at 600k now. All of you are selling this 600k. It's too much. It's too expensive. And as they keep on selling, they keep on selling, they keep on selling, and there's so much amount of Range Rover available, right? It's not only the sellers that are selling at 600k because it's expensive. Mind you, if you're not a seller of Range Rover, you are somebody that bought a Range Rover, so therefore you heard it's now 600k. You joined the selling market because people are many now selling. Do you think you will be able to sell it for the same 600k as a car dealer? No, you will not be able. I mean, it's second hand, right? So you have to start selling it for a little bit lesser. Now, a lot of other people that have Range Rover starts to sell. Everybody will now start selling it lesser than the next person. They'll start selling it lesser than the next person, and that leads to this situation. So this is what is happening here. The price was 600. The price now came up to 600k because so many people are selling it. It's starting to become cheaper because the buyers know that there are so many sellers, so they can be walking around and asking for price and try to price down the market. Somebody has to sell, right? Everybody wants to sell the asset. So they'll keep on pricing it till it gets low and low and low and low. Now, that is the understanding of what makes something called a supply zone. A supply zone is where something is so expensive that buyers feel like they cannot be buying this item at this price and they can negotiate for a cheaper price, and they start actually negotiating for a cheaper price. So therefore the sellers are forced to start giving out the order for it to start going down and down and down. So that is the supply zone. What is a demand zone? A demand zone is the exact flip side. There are so many people that want to buy an item, so therefore the item becomes expensive. So at this price of 300k, let me just pull down to this side. So somewhere around here. So I'm looking at the left of my screen now here. So at this level, this was a place where it was like so cheap. This, let's say 100k. So imagine Range Rover was like 100k. We know the standard price is 300k. But now we found out that, oh, we can buy for 100k. So many people come in, they want to buy because so many people are trying to buy. The seller is now having limited stock. When he sells the first 100 stock, he has less stock. When he sells the next 100, he has less stock. So he cannot be selling it at the same 100k over and over again. He starts to jack up the price. And you see how the price goes up to 200k, 300k, 400k, 500k. At 600k, people have given up. It's too expensive. We're not going to buy it anymore. We think we can get it cheaper from the other dealer. And they start going for people who are selling. They stop buying. To the point where sellers now realize, oh, we can't sell anymore. We have to reduce the price. We have to reduce the price. We have to reduce the price. We have to reduce the price, just like that. So now you understand supply and demand to a good extent, theoretically. Now, how does it lead to an order block? What is an order block? An order block is basically an area where buying last occurred before selling, or selling last occurred before buying. So, for example, this area, this candle I marked out here, this green candle, you know, this was where buying last occurred before we saw massive selling. Where do we have an order block for a lower place? So right here, we have an order block here. So you can see that there was selling before there was massive buying. That's what an order block is. Now that you understand an order block, let's look at what imbalance is. Now, imbalance is when you see massive price movements, right? Is when you see massive price movements. And how do you know what massive price movement is? Price moves in a way that it leaves something called imbalance. It leaves a space. Take a look at these sets of candles we have here. Do you see that the lowest point of this candle does not touch the highest point of this other candle? So take a look at it. On this day, they sold. This was the cheapest price they sold it at. This was the lowest price they sold it at, right? The next day, they sold again, and all that stuff. The third day, they sold in the same manner. They could not sell up to the lowest point of the first day. So therefore, there's an imbalance here. If you look at it, it's as if there was no buying in this price range because of this 2 days gap. So this area is what we call an imbalance. When you see price move so much that the lowest point of this candle does not touch the highest point, or when you flip it around, when the highest point, I'm looking for one, let's look for a demand one. When the highest point, okay, yeah, we have one here. When the highest point of the first candle does not touch the lowest point of the other candle, this is where you have a imbalance. So both of them are imbalances, but we call one bullish imbalance because it's supporting bullish market structure, it's supporting buying. So we call it bullish. And then we call it bearish imbalance when it's supporting selling situations. So this is a bullish imbalance, this is a bearish imbalance. Same thing for order block. This one here is a bullish order block. So mind you, it's opposite, it's red. It showed the last selling strength that occurred before buying imbalance appeared. So order block is only valid when there's an imbalance. That's what you need to understand. Another block is only valid as an order block when you have an imbalance. Now let's look at what we call supply and demand zones. Moving on to the next things. Before we move into sweep and liquidity, let's move into supply and demand zones. What makes a zone a supply zone or a demand zone? An order block does not make a place a zone. An imbalance does not make a place a zone. What makes a zone is that we have an order block and an imbalance that leads to a break of structure. That is what we call a valid zone. So, for example, okay, I'm going to leave this one on the chart, right? I'm going to leave this one on the chart. So, for example, you look at this place. This is an obvious high, and price closed above this high. This is a break of structure, right? We have an order block here. We have an imbalance here. So, therefore, this is a demand zone. The order block automatically is promoted to a zone. It is now promoted to being called a demand zone because this was all about buying situation. In this other one, we have an order block. So this is the order block, the last buying before the selling, right? So we had buying before the imbalance of selling, and then it led to a break of structure. So this becomes a valid supply zone. This is how you validate that a zone is either a supply zone or not. If it does not lead to a break of structure, it is not a valid zone. Mind you, remember, change of characters are also break of structures. So for example, I'm trying to look for one that does not lead to a supply. Okay, yeah, perfect. I think I have one. So here we have one. This is a good example. We have an imbalance right here, as you can see. The high of this candle did not meet the low of this candle. So we have an imbalance, right? This is a bullish imbalance. So therefore, what was the last selling before this? This was the last selling before this, making this a order block. So this is your bullish order block. This is your bullish imbalance or FEG. People that call it FVG. So imbalance, FVG, they are the same thing. So imbalance, right? Now, if you look at it, remember that this high here, this whole movement did not close above this high. So therefore, before price moved all the way here, let me do a price replay. Let's do a replay all the way to this point. So when you were watching price and price did this, as long as price has not closed above this zone, this is not a demand zone. Do you understand now? I hope you understand this. If you don't understand, do well to drop a comment. Tell me I understand this now. This is how you understand what supply and demand zones actually are. If price does not close above this area, it is not a break of structure. On this particular time frame, it is not a break of structure. But if you go down to the 4 hours time frame, you realize that this is a high and this is a break of structure. So this is a 4 hours break of structure. On that 4 hours time frame, you will look for the order block there and the imbalance. The order block and the imbalance in that zone is now the 4 hours demand or supply zone. So that's how you understand this whole situation. If over here we do not have a daily demand zone because price did not close above. Don't forget, that is a critical validation point that you need to always pay attention to. You need to always pay attention to that zone, that particular one. If price does not create that break of structure in that same time frame, that zone is not yet a demand or supply zone. That order block is not promoted. Now let's move on to the next thing. The next thing we have here is liquidity sweeps, read or stop hunts and inducement. So liquidity sweep. What is liquidity sweep? Well, we have a very perfect example. You can see how on this particular time frame, I'm going to take away this one right now. On this particular time frame, price moved above and came down below it without closing above this zone. Now, sometimes we have price close above or below a zone. But you are counting how long price spent above or below a zone. The shorter the time, the more higher probability that zone is called a read. The higher that read is or sweep is. So for example, like this one that went one single candle without a close. This one is what you call a high. It's a high probability liquidity zone. So it's a liquid. It's not a stop hunt yet. It's a sweep. So price has swept. It doesn't mean price reverse, right? It just means that price went above and closed below. What is a stop hunt? A stop hunt is an advanced sweep. What is an advanced sweep? So a stop hunt is this. Price sweeps above a high or below a low, and then price does what? Price goes to take the low of that entire leg. Basically, price creates a change of character after a sweep. Price creates a what? A change of character or a break of structure. It's called a break of structure, but in this case, you can call it a change of character. So a break of structure or a change of character of that leg. So you can see that this leg is the move upwards, but price fails to close above. And if price comes down, so just like what price actually did here, when price came down and finally closed below, so you see this close below, this becomes your stop hunt. So the hunted stops that was here. What do you mean by stop hunts? So normally a lot of traders would say, oh, this is an area. Stop hunts is, there are two types. There's the sweep stop hunts, there's the equal high and equal low stop hunts. But above an area, above a zone that has this kind of wick, people say, oh, this is a good resistance, this is a good support. They will place their stop loss for, in this case being a high, they will place their stop loss just above the high. So price would go and tick their stop loss and move below so much that it moves in the opposite direction and causes a break of structure. That right there is a stop hunt. It's hunted the stop. So it's more like, you know, when you hunt something, you run down and you shoot it and then you capture it, right? It's a stop hunt. So price triggers that stop and doesn't move in their favor. Another way to look at it is people who were now buying also. So they will place their buy, say, okay, market is creating, you can see market already created a CHOCH here, a break of structure to the upside. I expect markets to also, since price has moved up to this side and gone above it a little bit, or basically, I expect that price is going to go above this zone and continue to the upside. So price is going to do something like this and go up to this one. So I'll put my stop loss below this low right here, this break of structure, right? So you can see that this trade is actually very valid because the person is mistaking, right now, this person is mistaking this other block as a demand zone. He has promoted it without waiting for a close. So what happens is this, they triggered them in and then ran down to their stop. So it's a stop hunt. You can see that it's a stop hunt. It closed below the low where they pressed their stop loss. So it hunted stops. And then it continues in the direction of where the person was even taken in the first place. So that's a stop hunt. Then we have inducement or engineered liquidity. So what is inducement or engineered liquidity? Inducement or engineered liquidity is after this proper structure. So what is the proper structure again? Let's revert back to what we understand. The proper structure is this. We have for ourselves, I'm going to take this candle back here just to show you guys what a proper situation is. I'm going to take out all these identifications we have here. And I'm just going to show you guys all of this. So right here we have this high and this high waiting to be taken, right? And we have this high. This high is not yet a CHOCH. It's not yet a change of character. It's just a high, right? It's just a high that's there. Now we're watching price. Price does its move. Slowly it moves. It broke above this high. After these three candles were formed, right? As these three candles close, this is the close of the candle, right? What do? We start to look. Is there an imbalance? Yes, there's an imbalance. So therefore, we have an order block here. Okay, this last bearish candle becomes our order block, right? So it's a bullish order block. Now that we have a bullish order block, down here, it led to a break of structure or change of character, which is what we have here. So therefore, this is now called a demand zone. This is how you promote it properly. Now, where does inducement come in? What is an inducement? What is engineered liquidity? Engineered liquidity or inducement is that price recreates this whole scenario without, number one, without taking out this other block. So without mitigating this other block at all, if price recreates this scenario above this other block, it can do this. If price does this like this, if price does this whole scenario above this zone and does not touch this other block, we are cool. Especially, it becomes even better if it does not even touch the imbalance. It becomes even stronger if it does not touch the imbalance. So let's see what price did. So we're watching what price is doing. We're watching what price is doing. Price has created a huge move. Let's see if it creates. Remember, there's no bearish candle here, so we don't have like a reason to say we have other block, right? But we're watching. Now we have a bearish candle. Okay, we're watching. Does this bearish candle lead to an imbalance? Yes. Oh no, it doesn't lead to an imbalance. Okay, we're watching. We're watching. Now we're having more bearish candles. We're having more bearish candles. We're watching. Don't forget, we're watching. We have another bearish candle again. So now we have a bearish candle. Does it lead to an imbalance? Does it lead to an imbalance? Oh yes, it leads to an imbalance. So now we have an order block. This is an order block now. It's not a zone yet. Don't forget, it's still an order block. Now, does it lead to a break of structure? Does it lead to a break of structure? Let's take this high as a valid high, because obviously this price movement is useful, right? So this is a valid high. It's an order. Oh, it's not another block yet. It's another block yet because now it's an order block because we've had the imbalance. This is the imbalance right here. So these are imbalance, our order block, and price breaks above a structure. So now we call this a break of structure. You see this whole thing that happened here without mitigating this imbalance or other demand zone. You know, we have promoted this one to a demand zone now. Without mitigating this demand zone or imbalance, we have what we call engineered liquidity. So this is now engineered liquidity. This is my inducement or engineered liquidity. So with my inducement and engineered liquidity, I now have a reason to look at this chart and say this market has engineered liquidity. If price comes down to this place, I can enter, but that is moving ahead of ourselves. We now have imbalance, we have everything to call engineered liquidity. So we've identified how to promote an order block to demand on supply zones. Now let's head into actually trading demand and supply zones. So now that you understand engineered liquidity, how do you trade the supply and demand zone? Well, simple. This is an area where people saw price as cheap. So therefore, this is where you want to put your buy order directly here, right? You want to place a buy order when price comes back into these areas, right? Now, let's move forward a little bit. So price literally demolished inducement. You can see price literally demolished the inducement by taking it out. Price would always take out inducement before it comes for your zone, but it would create it first. It has to create that inducement to engineer liquidity. Whenever it creates it, that is when you start to say, okay, this area becomes much more valuable. I'm going to show you what that whole inducement and engineered liquidity looks like. So always watch out. If you have a zone before the inducement zones or before another of that kind of zone, mind you, that is an inducement or engineered liquidity. So how do you trade demand and supply zones? So let's trade a supply situation. So you see that when price came into our supply zone, mind you, how does this become a supply zone? We saw, first and foremost, we saw our usual. We saw an order block. This was an order block at first. So we saw an order block that has an imbalance. We saw an order block that has an imbalance. After it leads to an imbalance, this situation later ended up becoming a break of structure. So it led us to a break of structure to the downside, automatically promoting this order block to a supply zone. So what are we waiting for when we have this situation? Well, we are now waiting for price to retrace into our supply zone. When price comes into our supply zone, as you can see here, we'll sell these markets and we'll aim for the highest point before the move. So basically we would have done this. So upon seeing this whole situation, as price came in, we would sell, place our stop loss just below the entire zone, below the entire situation, which is the lowest point, sorry, in this case the highest point. I'll place our take profits at the target zone. So you can see it's just a 1 to 1.45. It's not really big, but it's okay. It's still profitable trade. Now this is how you trade supply zones. Same thing when you inverse it, that's how you trade demand zones. Now when you have all of this in your pocket, this is on its own is very valuable. Very, very valuable. Just like this one we saw here, you would have traded it because you see a break of structure, you see the whole thing, you would promote this into a supply zone and you would have traded it. Sometimes it fails, which is this. It fails. Sometimes it wins, and most times it wins, sometimes it fails. So that's how you trade supply and demand zones. Moving on to the next thing. Now that you know trading, you know supply, you know demand, you know order blocks, you know inducement, stop hunt, liquidity, and the rest. How do you now quantify and qualify a zone? Mind you, there are different zones. You can call it like a score matrix or a scoring pattern. You can score a zone 10%, 20%, 100%, 50% based on certain situations. Now, what makes a zone much more, what makes you give a zone a higher score? What makes you give a zone a higher score is when it has a combination of almost all these things actually. When it has a combination of all these situations, you then have for yourself a higher probability zone. When you have lesser and less of this situation, you have for yourself a lower probability zone. So for example, we have this supply zone right here, this one that we took a sell from. The first one we took a sell from, right? Let's quantify this zone. What are all the things we have learned? The first thing we learned was a break of structure. We have a break of structure right here. You can see this is a break of structure. What was the next thing we learned? We have a change of character slash break of break of structure. We have a break of structure which stands as a change of character. Why does it stand as a change of character in this case? It's simple. Market was moving bullish, upwards, 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 upwards. On the lower time frame, it's a change of character. On this time frame, it's a break of structure. So market was moving up, 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 and now market started moving down, 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 down until it broke up with the lowest point. So it is now a change of character. So it led to a break of structure slash change of character. Okay, we have market structure. We understand the market structure in that situation. We understand that this is an order block right here. This is the order block right here that becomes a supply zone. Now, at what level do you start to call it a higher probability zone? Standardly, it's a supply zone. What that makes it higher probability, lower probability? What makes it a higher probability zone is when it has inducement alongside with it. So just like we learned, right? Just like we learned before, back down here, we can now call this demand zone higher probability than this supply zone we had here. This supply zone, yes, it worked out. Everything has a 10% chance of something working does not mean it does not work. It only works for 10 people out of 100 people. That's what it means by 10% chance. This has a higher chance of working. Basically, if you are grading these two, you would call this one something, let's say 100%, and then you would call this one like 50% already, because you now have two, and one seems to be the higher probability. Now, what makes it a much more higher probability, a higher level? You can see it has inducements. Does it have a sweep or liquidity read? What do we call liquidity read? What do we call sweep? Is that price breaks a level, does not spend time above or below that level for much, and runs in the opposite direction, which is what we can see here. So what do we see? This is a low. This is a low, right? And we see price go up and price comes down. Look at how many days price spent below this place. Price only spent 1 day, 2 days, 3 days. By the third day, so it was already running out of the zone. So this is this break of structure can now be promoted to a sweep. So this, at this point, it's already becoming higher probability. So basically, we can now divide the system into 3 probability movements. We have probability number 1, so we'll call this the lower probability. Let's call it 30% chance. We'll call the first situation we had seen before a higher probability, which is like 70% chance. This one that now has a sweep beside it suddenly becomes what? Suddenly becomes a what? A 100% chance, because the other one is not 30, this one is not 70, that one is not 100, but there's not like a 100% chance anyway. But hypothetical situation, it becomes a 100% chance. Now, what makes it a even higher situation, a higher probability than that situation, is that it ends up now creating a liquidity raid, an engineered liquidity or an inducement just after the situation. So what does this make this now? We now have 3 grades. Let me list them out for you here. We have the grade 1, an ordinary supply and demand zone. So this is about, we call it grade 1, a higher grade. What makes it a higher grade is that it has a basic supply and demand zone, and then it also has a sweep. What makes it an even higher grade is that this whole situation now has a inducement. It now has inducement alongside with it. You can see how the grading score becomes even much more better over time. Now, when you have all of this, it suddenly makes that zone even higher probability. It led to stop hunt, it led to liquidity rates by breaking structure. So a sweep that led to stop hunts. So remember, stop hunt is a sweep that leads to the opposite direction being taken. A sweep is just a sweep. It goes below and returns. When it now adds a stop hunt to it, so mind you, sorry, it's not sweep slash, it's actually sweep. If it leads to a stop hunt, it suddenly becomes the higher probability. If it then creates an inducement, after that, it becomes an even higher probability. Now let's take a look at how DAX trade. This is what I said when I said supply and demand is the basics of what DAX and Kevin Talent is trading. This is where I want to show you what it really looks like. So now we have a sweep, a change of character, right? Price ran above the change of character due to the sweep and demand zone, and then creates an inducement, and then it creates inducement and continues. So you can see there are 2 ways you can trade this. You can either focus on the order block or you focus on the sweep, which right now I'm pretty sure you're seeing everything you need to see. So this is supply and demand advanced. The standard supply and demand is just when you have a supply and demand zone. It validates all the necessary by creating what? A break of structure, an order block, and an imbalance. The order block is then promoted to a supply and demand area or zone. You have a standard, you can buy and sell from there already. But by adding the advanced layer of sweeps, liquidity rates, stop hunts, inducements, or engineered liquidity to it, you suddenly get a higher zone qualification. Then there are 2 ways you can always trade both the supply and demand and the higher advanced ways of supply and demand trading. You can trade by risk entry, which is aggressive entry, simply by placing your order the way we practice up here, simply by placing your order just like this. Or you then dive into the lower time frame to look for an ordinary recreation of that situation. It doesn't need to create the whole thing, but it just needs to create a change of character. Once it creates a change of character for you on the lower time frame, you have what you need. So I hope I explained everything about DAX and Kevin Talent to you. It can, mind you, the inducement can happen after the CHOCH or just before the CHOCH, as long as the order block and the imbalance is not utilized by that inducement. That's what makes that being an inducement, is that it did not utilize that zone in the first place. So that's what makes an inducement. If that situation happens, we're chill, we're cool, we're fine, and everything is all good to go for you to take a trade. Now, again, this does not guarantee a 100% that any trade you take is going to work out. There are trades you take, you still end up hitting stop loss. But you are just trying to guarantee, as usual, that what you are trading right now, has a higher probability of working out. So I hope you learned something new in this video. Do well to share this video with someone you think may find it very interesting. May find it not just interesting, but may find it educational and very beneficial to their trading career. Thank you all. See you all in the next one. Peace.